All right, welcome to the next show of Lumida Non-Consensus Investing. I am thrilled to be joined by Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. I followed Mike for a long time. You should too. His Twitter is full of insight. We're going to cover a lot of ground today. We're going to talk about the effect of Trump and Biden on markets. Is there a Trump bump? We're going to talk about commodities, including Bitcoin, crude oil, copper, and gold. We're going to talk about the state of the economy. What do rate cuts have to do with this? Commodities and macro go hand in hand. So I'm very much looking forward to this. Welcome, Mike.
Oh, thanks for having me. I'm looking forward to it too.
Well, let's start right in. So is there a Trump bump?
Well, if there is, I guess 17% total return in the S&P 500 in the first half of the year, which is annualized, four times the average return is pretty good. I think the risk that people are underestimating about a Trump bump is that we're going to have a definitive election and definitive president in November. Yet we've seen that that might not be the case. So I think the market at this stage is priced for way too much optimism, and maybe that we get the Trump bump, but it's so expensive, volatility so low, interest rates are so high. It's just the lessons I've learned. I turned 60 this year. I started in the trading pits in 1988 in Chicago. That when you lick your finger and everybody's really bullish and all they talk about is being bullish, you should look for alternatives.
Well, I agree with, by the way, everything you said there. Where do you see evidence that politics is influencing asset prices and markets? You talked about the return year to date in the S&P, but are you seeing that affecting other markets?
Yeah, well, that's a good question. You hit me with a hard one right away. I think it's indisputable that if we do have a definitive Trump 2.0, I'd say right away that's very bearish for price of crude oil. It means drill it will. I think overall it's going to be bad for the dollar. Most people have said it might be good because of tariffs, but to me it's a bad thing for the dollar because he's trying to help increase U.S. exports and he's pushed back on the dollar before, and pushing back on the Fed is really bad for the dollar. We can go the way of Venezuela. So those are to me some of the key takeaways. And I think the issue I'm worried about is from an equity standpoint. Everybody tells me, oh, the Fed's going to cut rates and Trump's good for equities. Well, we've priced in that about the most extreme I've ever seen in my lifetime. I just look at one thing that I like to point out is something that used to matter, total $56 trillion, almost $57 trillion. That's a total market cap of U.S. stock market. It's 2 times GDP. On the way up, the last time we were on a similar trajectory on the way up was 1929. We all know how that worked out. So things are very expensive. And then I look at simple stuff like the S&P 500 versus housing. It's the highest in our database since 1977, since Bloomberg Commodity versus the Bloomberg Commodity Index, highest in 25 years. So the thing I'm worried about is we're priced for so much optimism, realism, just normalization in markets is what we should expect. And typically that's what most people forget when you get to these very lofty levels.
Right. So you cited two statistics there. One was Tobin's Q ratio from a Nobel laureate, where you compare the market cap to GDP, and then the S&P 500 housing. What's interesting there is you're comparing the financial asset to a real asset in both time, and the implication is that these are bounded, these ratios, and there's some kind of mean reversion at work.
Yeah, I see. That's one thing I appreciate about you. You dig into the mathematics a little deeper than I did. I kind of more in the 30,000-foot view. This is how things have been in the past. This is how they are now. I haven't used that housing statistic for about a year. I just looked it up before we hopped on because I wanted to see how it is. And I'm sitting here in Miami. I look around, and you can just everybody knows what's going on in real estate in the country. And just Miami, it's basically 2x that or 3x that. It's a gamma here. And it's just so extreme. I'm sorry.
No, go ahead.
Yeah, I just thought it was distortion. So I just pulled that one out, but there's so many of them. The bottom line for me, I like to point out, is this is the number one statistic that got me really bearish in 2007, which means I had to suffer. We all saw the movie The Big Short, and I had moved from a hedge fund to run commodities at S&P. Was just a simple measure of you take the VIX volatility index, 52-week moving average, 100-week moving average, subtract out the T-bill rate. That's the lowest now since 2007. That was just an indicator. A lesson I learned in the trading pits was volatility is always mean reverting, and it's just so low. It looks for excuses. Markets are just waiting for that catalyst to revert in terms of volatility, in terms of price. And so I anticipate, what will those catalysts be? I don't know. I mentioned one, there could be a little bit of an issue with the election. We do have something that's changed completely in my lifetime, and this is a reversal of détente. The Soviet Union fell in the late 1980s, and that's completely reversing. We have a Cold War that's heating up globally. And it was nice to see on the tape the other day the Prime Minister of Finland pointing out one phone call could end this, from President Xi to President Putin, but that's not happening. And it's part of the reason I've been very bullish gold too early. Could some people say wrong, but I think that's where I think gold's going to be the enduring asset potentially as we have some normalization of other very risky assets. So that's also part of being a commodity guy. At least they have to have something that's going up. And gold is one of the few commodities I expect would keep going up.
Well, it seems like after the debate that we saw last week, that commodities started to ramp, and that markets are expecting more inflation, which is what you would expect under like a Trump administration, where you have higher deficits and a renewal of tax cuts, and you've also seen Bitcoin respond to that as well. But yeah, you pointed out that we are seeing a reversal of these major trends, and another one is the nearshoring phenomena. With the
Can I ask you about that? Is it nearshoring, deglobalization, or GMTFO China? Get me the heck out of China. I'm kind of asking you the question. To me, the sense is it's just that every major country in the world that thought China was a reliable, safe partner that's not going to support wars in their backyard, saying, okay, well, I can't trade with them anymore.
Yeah, I think it's all of the above, right? So Vietnam is benefiting from the movement of operations from China. Mexico is also benefiting. So is India. So maybe you call it friendshoring. And then you've also got reshoring from Taiwan with the CHIPS Act, although that's delayed. These foundries aren't coming online fast enough. TSMC, Taiwan Semiconductor, is building another foundry in Taiwan. The advanced 3 nanometer production facilities. So, but overall, though, you put that together, and it's a story that's consistent with inflation. I mean, those are, China's a low-cost production center. There's a reason why these factors are domiciled there, and moving to a higher cost area that requires training, a new labor force, and that's going to have some consequences. Your point on VIX I thought was very interesting as well. I've noticed this too. It's almost like VIX is broken. Like, how come VIX isn't, even when you see these mild down days, we really haven't had any severe down days, as we've had, I don't think we've had a 2% down day in like over 100 days, right? But let me challenge you on this one. I'd love to get your perspective, which is that there is volatility, but it's not in the Max 7. The volatility is everywhere else. And as you know, the definition of the VIX, which looks at the money, implied volatility for a basket of securities, and then it weights them with an algorithm, that is weighted towards those Max 7 names. But we are seeing volatility and downside volatility outside of that category with the breadth deterioration. So is it that maybe the volatility is there, but we're not measuring it in the correct way, or the volatility is just an area that's outside the the yardstick?
I think what you pointed out are early indications of cracks in the very very low complacency or high complacency market that I view as it's just a tinderbox waiting to spark. It needs a catalyst. We get some normal things that used to happen in normal markets, in bull markets, and say I'm using the S&P 500. It's basically beta for the world. A normal 10% correction. This year we've only had 5%. The bottom last year in October was 10%. And I've been writing about that. Let me get through that test so I can really make decisions about being bullish Bitcoin, because it failed on the 5% correction. So my thing I like to point out is I compare everything to beta, S&P 500. So you look at crude oil, the number one commodity on the planet. It's been stuck in a narrowing wedge pattern for almost 2 years now, and it's on the back end. Which normally does in crude oil, it's very rare for it to go up to 90, and if it does, it makes the whole economy tilt lower. And it's very normal since 1981 to go down to 40. To me, that's part of why I wanted to push back a little bit earlier. I think we're heading towards a normal, pretty severe deflationary cycle in the aftermath of, thanks for that chart, and on the aftermath of the biggest money pump and liquidity pump in history. So let me just give you my macro that I was early on. I'm pointing out is, and I can mention 3 or 4 books. I love your bookshelf that pointed this out. That is, in the history of mankind, in history of markets, when you have a massive pump in liquidity and assets rise, they almost always come back down and hard. Price of Time was one by William Chancellor. Boom and Bust by Quinn. I forget the other author. And it's just, and I've tested that in the system. So that's happening in some commodities. I think it's just a matter of time to happen in risk assets. So we're just getting past this period, unprecedented, where we had 0 to negative interest rates in most of the rest of the world. We pumped up prices of all assets to where we are, which is logical. And now that that it's ending, and it's just a matter of time. So from a commodity standpoint, I see nothing but deflation. So let's look at the number one measure of heat, electricity, and fertilizer in this country. Natural gas, partly because of the Russians' invasion of Ukraine, pumped up to 10, and it dropped down to 1.4 this year. Right now, it's around 2 and change. That's an 80% correction. It's at the same price as it first traded in 1990. At least it got to that level. You look at crude oil, price of $83 a barrel. I mean, that the high was 130. I think it's going to 40. That's just a normal cycle, because what commodities almost always do, the lessons of Adam Smith, is they have to get below their cost of production. The cost of production in the U.S. is 55, the world's largest producer, and we've done that partly for demographics, but mostly because of advancing and harnessing that technology. Here's one thing that just happened last week. The number one measure of like what crude oil is to energy, corn is to food. It's the most significant food on the planet, and it's also energy. The price of corn right now, around 4, was first traded in 1974. It's plunging because of one major reason. We had the biggest pump in prices in 2022 to 8 in 10 years, and there's so much elasticity from that price of tomorrow by Jeff Booth and Adam Smith, that all that supply is coming on this year. Unless we get a bad year, we're going to have we have too much supply left over from last year. It's a normal cycle in commodities. And the only thing, I think the thing that's holding everything up is this US stock market capitalization versus GDP. And the Fed knows they can't really cut rates, because I think Mr. Powell knows he tilted towards telling the market he's going to cut rates too soon, but all the data is starting to tilt the other way. You look at unemployment. Our economics team thinks that payrolls are not as significant. Unemployment's probably going to go to 4.4% this year, the lowest 3.4%. It's never bottomed from that level without going to 6%. So to my whole macro thing is a normal cycle is going that way. And the key thing to watch is China. So I'll end with this. I bought a Chevy Volt. It's 10 years old now. It's a plug-in hybrid, 2014. I've got 10 years on it, 80,000 miles. It's a great vehicle. It cost me in dollars 10 years ago, 36 grand with subsidies, 29 grand. Right now, you can buy a BYD. It's triple the mileage, and it's a fraction of the cost, and it's a good car. And we have to have tariffs to keep that from coming in the market into this country. Yet it's just a sign of significant deflation coming our way. And what do we stop? And the one thing that's keeping us away from deflation is the U.S. stock market remaining elevated, is the way I see it.
Fascinating. I really appreciate that. So your thesis is that, hey, we're going to see economic softening. This is yet another cycle. We've seen cycles before. Look at the ratio of financial assets to real assets. They're overpriced. Things are going to roll over, and the Fed's behind the curve. Therefore, there be dragons. Let me challenge you in a few different areas.
Please.
One I would say is, like, the demand for energy has never been higher. The transition to renewables is going slower and longer than anyone thought. Solar isn't reliable enough. You can get cloud cover, same with wind. And we need more old energy. We need more natural gas. We need more nuclear. We need more all of the above. And as you pointed out, it's a key input driver. We have wartime deficits. There's no war. We have CHIPS Act. We have Inflation Reduction Act, which doesn't seem to reduce inflation as far as I can tell. And we have infrastructure spending. There's really no end in sight. We've got a boomer economy. There's a lot of spending that's happening too. Consumer disposable income still looks abundant. They still have capacity to borrow on credit versus historical periods. And then, household balance sheets are at record highs, in part due to, equity valuations. I think equity is an interesting conversation in its own right, for sure. But And I think you add to that this friendshoring phenomena that's going to increase the cost of goods sold on goods. Everyone wants services, right? It's a services economy. Restaurants are packed. So I don't know, I don't see the deflationary impulse. There's no credit bubble that's going to contract. There is commercial real estate, which is taken on the chin. That whole area is experiencing a recession, and you're seeing price deflation there. Home prices are still hanging in there, coming in softer, right? Multifamily starts are like horrific. Single family is doing okay on the lower end. And if and when the Fed cuts, and I think they will cut. I think we all think they know they'll cut. They said they'll cut. They kind of have to cut now. I've never seen so much chorus around the Fed cutting since Jim Cramer was on CNBC in August 2007 when he said they know nothing. This comes close. It's not at that level yet. But when the Fed does cut, the change in psychology, I believe, will be significant, right? People that are on the sidelines that haven't purchased a home are going to say, oh, I can buy now because I can refinance. Even though, of course, the Fed controls the short end of the curve, they don't control the long end. It kind of doesn't matter. This is all about psychology. And I do agree, though, we are seeing declines in inflation. It looks like, by and large, the battle against inflation has been won, but it may be too early to call victory given some of these other dynamics. Any quick reactions or rebuttals there?
Yes. We, within a year, maybe two, will see problems with deflation. And that's only because of the normal cycles. When you raise the bar of the measure of inflation, we just look at the number one component CPI, owner's equivalent rent based on the average on a home. It's gone from basically 200 to almost 400 average price. That base is so high now, it just needs to come back a little bit. So you started with energy. Let's start there with energy. There is, yes, all advancing economies, it's the essence of the human condition, is using and harnessing energy properly. And we have significant tariffs against the number one new source and cheapest source of energy in the planet now is solar. It's just getting there. Storage is just a matter of time. It's getting there too. I installed solar in my house 10 years ago. It worked great. There's no moving parts. And it just cut my electricity bill by 2/3. I've done there. I tested it. It's just going there. It's a question of what stops it. So I fully expect we'll use more and more energy, but it's just how we attain it and what sources we're using, and then storage. It's just getting it just can't underestimate how fast that technology is going. So my standpoint is, let's look at the number one thing that's really keeping things pumped up right now. Is we had the biggest liquidity money pump in history. We still have the repercussions from that, and of course, the largest, 6% largest fiscal spending of GDP outside of a war.
They haven't dispersed all the funds yet.
What's that?
And they haven't dispersed all the funds from those.
Yeah. So, but we still have this, this unstoppable force of massive fiscal spending, 6% of GDP. It's never happened outside of a war or a recession, and it's just, where's it stop? I don't know. Some point it's going to, but that's keeping the Fed partly restrictive, because they know here's the thing you and I both know, having I've been a Fed watcher since '88, is for the concept of the Fed to ease in the middle of a significant speculative frenzy. I mean, I did the math a little while ago. You get that S&P 500 25% above its 100-week moving average. Fed doesn't ease in that environment. That's when they take the punch bowl away. They can't, though, because they help create this. We're at that unique spot. It's lose-lose. And you look, what's happening is almost the rest of the world is cutting their rates because they're heading that way. The world's heading to a recession. If you look at first of all, let's look at the average. First, I'll start with this. The Fed funds rate in this country at 5.33% is about 3% above CPI. The average for last year is 1.5% below. So it started at 5.33% if interest rates matter. And then you look at the average of the next 5 countries in the world versus our 10-year notes, obviously inverted. So that used to matter, inverted curve. It will eventually. But the average of the next 5 countries, including India, is about 100 basis points below the U.S. 10-year note. China is 200 basis points below the U.S. 10-year note. So there's severe deflationary forces in the second largest country in the world, and they're trying to export it. That's not going to get better, I don't think. And of course, it's just this process of China is going the way of Japan. But so my point from inflation is people think it's enduring, they feel it, but we have not had a real stock bear market since the bottom in 2009, maybe a little bit in 2011, maybe a little bit in 2022. But every single time people know, oh, you dropped 25%, you got to buy more. That's going to change. At some point, we need to go down and stay down for an elongated underperformance period. It's always happened unless history has changed. And particularly it happens when you just get too expensive, like the 1987 crash. We weren't expensive. We just were for a short-term period. Here's one little statistic. I love pointing out things like, there's so many little things there, but you just look at stock market cap to GDP before the 1980s and before 2008, around 2007, we were about 1.2. Now we're 2. So just very expensive. And that's just looking for, that's where that deflation is going to come from, just normal reversion. But then from a commodity standpoint, the number one measure of, I pointed out, heat, electricity, and fertilizer, natural gas is plunged. Why? Because we just create more of it for less every day. And then we just know that what's the fact that since the end of 2019, money supply in this country is up about 35%. That's never happened. Okay, so that's going away. So I think what's going to happen now, let me predict the future, is the lessons of Jeff Booth, who taught us that humans are just about measures of error correction. We have learned the lessons of way too much liquidity inflation. What does inflation do? It hurts the little guy the most. It hits the average person. 55% of people in this country are wage earners. People like us who own stocks and have decent jobs and own property, it helps us. But we're learning that the vote is going for, for everything is against inflation. So next time the Fed is at the trigger finger to cut rates, there's going to be pushback forever, just similar we've seen in Germany since the Weimar Republic. Knows you can't cut rates because the last time you cut rates too much, you ruined it for everybody. You made it difficult for me to buy groceries. It might not be true so much, but to me, that's where we're going. And I just look at from a technology standpoint, it's unstoppable. If we keep that money supply somewhat stable, look at everything versus the price of gold. So I'll end with this. You mentioned earlier about equities versus real assets. The best way I think to look at the stock market sometimes is versus a real asset is just look at gold versus the S&P 500. The ratio right now is 0.43. The average since 1900 is 1.34. Okay, yes, there's disparity. Stock market got really expensive in 2000. And so to me, it's just a matter of time we go back to that 1-to-1 ratio versus gold, which is part of the reason I'm still bullish gold.
Right. So, there are also just a couple, versus the 2000 cycle in 08. In 08, we had a credit cycle that was involving speculation in the housing market, where banks were extending credit to buy homes. And that also was financed by the capital markets with subprime securitizations, created a bubble there, right? In the 2000 market, we had a tech bubble. Here we don't have bank credit growth, right? It's flat year over year. The banks are on their heels, just trying to conserve liquidity and get by. They have these bank hold to maturity issues, and they're trying to heal and just generate profits to get to the other side. We do have financial assets that are ripping, but at the same time, we have earnings growth as well, right? So, NVIDIA is not a Cisco. They've delivered on earnings growth. And the forward PE is around 21, which is on the higher side, but it's also consistent with earnings growth. We've seen multiple expansion, but at the same time, we're seeing companies, generate record profits. And we didn't, in 2000, that wasn't the case, right? We had a PE ratios of 1,000. We don't have that right now. And, it seems like the market's got more discipline, right? In 2001, we had, Cathie Wood's ARK hit record prices, and now it's not. It's actually in a bear market. So yeah. Speculation has maybe shifted. Maybe it's in Tesla stock today. Maybe it's in a new, maybe it's in NVIDIA. I think that's very well possible. But is there not a fundamental earnings-led driver to the equity rally?
Well, we have to admit we have to go back to where we started. Is the government is spending 6% of its GDP every year in deficit, so that's part of it. I think the key thing to remember here is the lessons of Jeff Booth of Price of Tomorrow is BYD is doing to Tesla like Huawei is doing to Apple. It's just the technology is moving so fast. And yes, I completely, the profits are great, but we have to remember what got us here is the biggest, longest period of zero interest rates in history and the biggest money pump, just throwing money at anybody in history. I mean, compared to a credit crisis, I mean, when government just writes checks to people, yeah, assets are going to go up. We're going to get inflation, and assets have been going up, and there's still a lot of that money running around. So that to me is the party that still needs a little bit of reversion. So I'm not saying you should be short equities, but I think it's really a time, it's been that way, to look for alternatives. So for a while, that's been Bitcoin. Bitcoin is known as the fastest horse in the race. And lately, since that perfect storm for new highs in Q1, it's showing pretty significant, the leading indicator is lagging, showing divergent weakness. So I'm getting a lot of signals from my indications, from the macro indications, very low volatility, high interest rates, leading indicator lagging, just the relative price of S&P 500 versus the MSCI ex-US index at the highest ever. So many of those things that say, yeah, there's just levels you're not supposed to be overweight long. And also, I just love how people justify the higher levels when, like, yeah, I remember hearing that in the past. And there's alternatives, like 5.3% in a T-bill.
There's this great quote from John Templeton. He says, bear markets end in fear and despondency. Bull markets grow on skepticism. They end in euphoria, right? And if I look at like 2021, we had SPACs. We had a lot of nonsense transactions. We had IPOs at a significant volume, just like we saw in the dot-com era. And we don't have that now. We have slow pace now. Capital markets are starting to thaw a bit here. And we've got this theme and narrative called AI. We're probably ahead on the delivery of AI. Right now, it's all in the build infrastructure, right? So the semiconductors are benefiting from all that. We're going to see AI PC laptops. I don't plan on buying one. I still have yet to heard of any use case that's compelling. We can imagine all sorts of use cases. I want the personal assistant AI, but no one's offering that yet. So, but it seems to me like, I don't know, this might be closer to 1997, although I do agree that there are pockets of crowding and speculation. Interesting market in that certain sectors are trending and some are trending the wrong way. Either you're on the trend and you're doing well, or you're on the wrong trend, you're not doing well. And it's a very unusual market in that way. I'm looking at like Tesla right now. I'm asking myself, maybe speculation is just crowding in a handful of names. And when you see like 3 gap ups that lift up like this, that's one hell of a ramp. And this is on news of a beat on the deliveries, although the deliveries have declined year over year. So we can move past equities, but I think where assets are pricey. NVIDIA is re-rated. Taiwan Semiconductor ADRs are 20% pricier than listed shares, and it seems to me like we could just see a rotation to all the other areas that have been left behind, but are still growing earnings and have attractive median valuations versus the Mag 7 names, which or some of the Mag 7 names, which might not perform as well. So you kind of like the catch-up rally. And obviously we got August, September seasonality, which isn't best. And the other point you raised, Mike, I think, is the Trump bump. Like there is, I agree, that's fully priced in at this point. That's fully priced in. So,
well, here's one thing I want to ask you in that. Let's just assume there's a definitive election. What if we have some kind of hanging chads or issues with what we had in the last election? There is still potential. This is not going to be a smooth process.
Right.
I'm not saying it will happen, but that's not, when you have the pendulum completely swinging to one side of no risk, what happens. It swings back a little bit. I think that's what's happening right now. Last year we swung way too far towards recession. Some of us, I was wrong. We swung way too far this way towards absolutely no recession, no risk, and we're just pendulums tilting back.
I think we're in agreement.
I just want to. You mentioned 1977. 1997. Yeah, I remember. Well, I was with clients and running money with clients. I remember having one great trade, and just by watching pattern recognition, observation of prices of Eurodollar futures. But back in 1997, the stock market cap to GDP was 1 to 1. Now it's 2 to 1. There's levels you're not supposed to overweight. That's the
So,
level.
fair enough. I'd say there's a difference between now and then as well, is because companies today are more productive,
Of
have higher
course.
margins. NVIDIA's got a 80% profit margin. So,
The key
you
thing is,
know,
has human nature changed? I'm reading the latest book I'm reading. I have to admit, it's come somewhat biased. Is The Devil Takes the Hindmost by Edward Chancellor. And it's just about human nature and speculation never changed.
Not like I agree. By the way, the other book you mentioned, The Price of Time, which I think came out 6 months ago, is a phenomenal read.
Yeah.
You learn about the history of money, the history of interest rates, which turns out interest rates did not start in fiat; they started in real assets. So Mike might lend me a goat, then I owe Mike like 1.5 goats 6 months from now. That's how interest rates started. So fascinating read. I'll show you one last chart, then we can move on to your thoughts on commodities and Bitcoin and copper. But I'm going to show here really the bear case and the bull case in two different charts, right? So the bear case is you look at the current PE ratios of the stock market, and what you find is that they're elevated. I don't know if you can see my screen here. These are all forward PEs. Unfortunately, I'm looking for the current PE here. Let's see, current PE. So, the current PEs are elevated. They're not at 2021 levels, but they're within, earshot. They're below 2000.com levels. But the bull case is earnings growth. Okay, here's a good one. Here's the forward PE ratio, the actual and the median. So the actual here is obviously showing the impact of the Max 7, the weight, across those names, and the median. This is like the mid caps and small caps that haven't participated as much. So mid caps are priced attractive as compared to the 2021 era where they were pricier. They were kind of where Max 7 was now. They're price attractive as compared to the .com era. But I think the story here could be earnings growth, right? If I look at on an earnings adjusted basis, if I look at say the PEG ratio, what you see is that the market is expecting earnings growth. And so I think the question comes down to, does the earnings growth show up or does it not show up? Are analysts ahead of their skis or not?
Well, here's one thought on that. I'm kind of backed off digging in the weeds of equities. I'm focused more on commodities, and I'm going to have CFA and all that stuff. And it used to focus on it more. But the key thing to me is consumer sentiment, and it's still good. People still have jobs, but the interest rate, the unemployment rate's going up. In fact, for the first time since 1982, unemployment rate is crossed above the CPI rate, was heading lower, and it's just you see the trajectory there. I think that's towards that deflationary recession, which is normal. And then we have this issue that equities are so expensive, inflation is still high, and the Fed knows you can't cut rates in a speculative frenzy, or you're going to make the mistakes that Chairman Powell stated back in the Q4 2022. They will push back in inflation. So that to me is the standard we are. I think we're going to get to that point. We have to see a little bit of normalization of kindred spirits, and that's just the way things have always worked. But you're seeing it in so many indications. So here's one of the key things. I'll help tilt a little to commodities. I mentioned that we all know the unemployment rate's already kicked in the somber. It's never bottomed at 3.4% and not gone to 6%. Now that's only since 1947. Sorry if that's not a long enough data set. So from a commodity standpoint, we have diesel demand. Diesel is the grease of the economy. There's not a lot of trucks being replaced by EVs. It's down 5% from the peak in 2022. It's the same as 2014 in this country. The last time we had a similar trajectory in diesel demand was the Great Recession. In fact, it happened after. It was a lagging measure. Unleaded gas demand, same thing. It's peaked in 2019. It's low and it's declining from those bounces. It's down about 5% from 2022. Container boards, corrugated boxes. The downward trajectory in container boards is very much coincidence exactly about 2008 and 9. They're in that plunge. In fact, it's near levels that were in 2008, and where all my indication for commodities and what you're seeing in China, plunging bond yields in China are, and even from my commodity standpoint, is this is just getting started. It's a normal cycle. You pump prices up too much, and it creates a lot of supply, reduces demand, and you go
Right.
down. And you have to find a lower price cure. So from my standpoint, everything is tilting that way, and the only key thing is that stock market staying up. Yeah, earnings are great, but there's a reason they should be great too, because we have an event that is not in anybody's models. That's why I have to go back and double
Right.
down in the history books.
Yeah.
What we did with the COVID and throwing money at people, and what we did for that longest period ever of zero interest rates, which you mentioned from the price of time, is unprecedented. And if we can get through, here's a question I'll ask, and if we can get through that, through this period, and not have the repercussions of pumping so much money in the system and everything's fine, then what's going to stop us humans from continuing to do it until something goes wrong? That's
No,
to
I
me
think
is the
that's
problem.
that's the easiest bet to make, right? Humans as a civilization are relatively new to central banking. It's less than 100 years old, and the sample size of business cycles you can count on your fingers. So there is a confidence that central bankers have to exude that exceeds the precision in their ability to manage markets and the economy. And like, you know this, and we know from animal spirits. Like, animal spirits is a big driver.
Sentiment, yeah.
Sentiment, exactly. So, that's not on the model. We don't know which model to pull out. Is it the model where people wake up excited, or the model where people wake up despondent, right? So after an event like 9/11, people woke up despondent and behaviors changed overnight, or after COVID. But then certain events can, change that very quickly. So yeah, I think it's quite interesting. Let's shift towards the U.S. dollar. I think the U.S. dollar is, in my view, it's like an anchor way to think about a lot of commodities, because commodities and assets are priced with respect to dollars. I'm going to pull up a screenshot of the U.S. dollar.
So what are you using, Dixie or trade weighted broad? You can't really use a trade weighted broad, but as far as the most robust negative correlation to commodities, I use the Fed's trade weighted broad. What are you using, Dixie?
Whatever you like. We can, yeah.
Okay.
Overall, look, it's a great indicator, right? When dollar strength is happening, usually it coincides with risk off. Dollar weakness usually corresponds with risk on. And what are your thoughts on where the dollar is and where the dollar may be going?
So let me start where I don't think you expect me to go. Let's start with cryptos. And I've started pointing this out 5 years ago. The most widely traded crypto is the dollar. It's not Bitcoin, it's Tether. On a normal day, you click on volume and you see what's traded. Tether trades double the volume of Bitcoin. This is something I'm enjoying pointing out forever, certainly to hoping our politicians would see this. By the way, when you have a technology that's completely decentralized globally, organically adopts the dollar as its base layer, you probably shouldn't mess it up. And most of these crypto dollars, which is about $160 billion now. I remember when Tether was only 2 billion. Now it's about 112. And of course, it has other cryptos. Most of those are invested in U.S. treasuries. Why? Because there's no better place on the planet than the U.S. dollar as far as fiat currencies. What's happening now is the number 2 most widely held reserve currency next to the dollar is now gold, partly because of what's happening with Z and Putin and unlimited friendship. So I wanted to start there for the dollar, for people to understand how I really got in the macro of cryptos and the technology and everything. But the other thing I want to point out is, let's just look at the yen. It's unstoppable. We're like 161 right now. That's the lowest yen since 1986. I love that date because I started in the trading pits in 1988. So, and I remember I worked for Japanese firms. It's unstoppable because of U.S. interest rates are too high. Why are they so high? Partly because the exorbitant privilege, everything we want to call it. But the problem is also what's been the complete correlation with the dollar is the U.S. stock market outperforming the world. You overlay the dollar versus the S&P 500 divided by the MSCI, they're tick for tick. So my point is, I don't think we're going to see dollar weakness, stop the dollar from breaking into these other economies who have to support their currencies until we have something give that boosted up in the first place. That's the U.S. stock market. That's the lose-lose, and we're getting there now. The yen is unstoppable. Sure, there's going to be intervention, but we all know that happens. Traders, hot money, just wait for the invention to put their positions back on. So I look at it as, compared to other fiat currencies, it's unstoppable until something breaks. Then there's gold. And I do want to point out that how I had to start with the foundation with the technology. And this is one thing I think some of the strategists I see who are not recognizing what's happening in this new market. And that's from a guy I came from futures. And I remember futures just taking over from, I was in the trading pitch in Chicago, and all the New Yorkers used to get upset when the futures would move markets. They move their treasury markets. And then we all saw what happened to ETFs. It's just a better way to transact. That's what's happening in cryptos in terms of tokenization. And the bottom line is they adopted the dollar as a base layer. So I look at the dollar as unstoppable. What's going to take the drop is something we all don't want. It's probably going to take some, and if we do have a problem in like 9/11 and or things that when you downgrade the US debt or some kind of global attack, you know what happens to risk assets. So that's why I'm still tilting back towards gold.
Interesting. So again, what's really interesting about that story is that historically, when the yen was peaking, like in 2022, that was also a bottom for U.S. equities, right? And that correlation is broken down in reverse. Like equities are going up, even as the yen is going up. The U.S. dollar, you see this red line here. When the U.S. dollar goes up, that's generally been risk off. Here we are, the U.S. dollar near record levels, not quite there. It's curling over a bit, but U.S. equities have shrugged off the strength in U.S. dollar. It's shrugged off higher for longer also. But you could say, maybe it hasn't, right? It's been the AI theme that has shrugged it all off, which is driven, I believe, by earnings growth. But all the other parts of the market haven't. And they really have been walloped by and large, right? Other categories just haven't participated, if not, so I think there are two stories there. Let's talk about, Bitcoin now. Like, how do you see, Bitcoin, where we are in the cycle? The Fed seems poised to cut rates later in the year. Giving your comments around, maybe like a deflationary outlook. What does this mean for the outlook of Bitcoin?
So I'm very concerned that the leading indicator, most widely traded 24/7 risk asset on the planet, that just was part of the biggest ETF launch in history, is lagging for a reason, because it's going to be leading risk assets lower. And that's the key thing, is that you can look at Bitcoin right now as we speak is at 60,000. Now that looks like a bull flag, but if you overlay that, take Bitcoin, divide by gold or divide by the S&P 500, it's tilting downward. And I've been showing this on some of my posts on LinkedIn. I obviously publish them on the terminal. It's showing pretty significant divergent weakness, and people say, oh, it's just normal. Like, no, it's not, because you have to remember what got it to spike recently was a perfect storm for new highs. The launch of ETFs in the US, I mean, we waited for that for a decade, starting with the Winklevoss twins, the halving at the same time, and beta making new record highs. Now we're in the hangover. The question is, what's going to take for that hangover to end? And that's why I point out is this leading, some people call it the fastest horse in the race, is telling us there's a problem. And I look over that, I point out that, we show how low volatility is and how high the equity market is. So I'm think what it's doing right now, it's showing that we just need a correction in risk assets. And this is on the end, tip of the bell curve of risk assets. So I do enjoy when people say to me, oh, the deficit is ballooning and Bitcoin's a savior. I mean, yeah, the problem is it's 3 times the volatility of beta, yet gold's about the same or less, and T-bills are a lot less. So I think what's going to happen is at some point, we're going to get this normalization of very expensive stock market. It's going to pull everything lower, and the things that are the highest volatility that don't have a designated negative delta to the stock market, like a put, are going to go down. And that to me is what this Bitcoin's indicating right now. So it's at 60,000. I'd love to see. So here's what I think. People always tell me this. They tell me what's going to happen. I'm like, show me the proof. And that's my job, I think, is to pattern recognition. As if there's any skill, I think sometimes is I get it wrong. Sometimes is a pattern recognition. The pattern recognition I'm showing right now is Bitcoin. It's showing divergent weakness for good reason. And it's probably indicating there's a problem in the bigger picture of all risk assets. Now, at some point, if I can see it showing the opposite, like in days like today, S&P 500, it's always up the day before the 4th of July. It's always up the week of the 4th of July. And Bitcoin's down 3%. That's not a good sign from the fastest horse in the race.
The argument that there's a variable that changed how we look at things. The variable is NVIDIA. It's a confounding variable. So Bitcoin is down 3%. Yeah. NVIDIA is up 4%. So Bitcoin was the fastest horse and its momentum asset.
Good point.
And it captured spirits, right? So I think, this is really
And
a
NVIDIA
mad
has earnings.
NVIDIA has earned. This is a mag one market, right? So
Yeah.
here's the story. So you have like the Olympics and Bitcoin shows up and like runs around all these other risk assets in a bull market. And then Hussein Bolt shows up and he's wearing NVIDIA.
Yeah.
That's his Hussein Bolt
Good
is
point.
NVIDIA. Everyone said, what the
Yeah.
hell is going on here? And people that would ordinarily buy Bitcoin, they're buying NVIDIA, or even better, NVDU, which is 3x NVIDIA. I'll tell you a funny anecdote. I had dinner with a friend last Wednesday, skillful investor. He knows OG Bitcoin investors like Michael Turpin, right? Michael Turpin was an early, amazing individual.
Yeah.
And I said, well, how do you think about Bitcoin now? And he says, I own NVIDIA. Actually, I don't own NVIDIA. I own NVD. By the way, I'm not getting financial advice. It's 3x levered. Like, be careful, all that stuff, right?
And NVIDIA is 3.2 trillion market cap, and Bitcoin's around $1 trillion. I mean, you're right. I mean, it's the fastest horse in the race, definitely now.
I think it's really that. It's, if Bitcoin is down, it's because NVIDIA is up. I just showed NVIDIA on the screen. Bitcoin down, NVIDIA up. And I think that's what it is. It's not even Bitcoin competing with Solana or ETH. I think those are actually in the same boat now. Just like other energy stocks, rise and fall other energy stocks or Mag 7, right? It was Mag 7 and all the rest. Now it's NVIDIA and all the rest. And, NVIDIA is a real fundamental story. It's cheaper than a lot of software companies. It's been more expensive in its history than it is now, like on a valuation basis. It's not as attractive as it was in January 1. As it is, it's gotten pricier since then. But anyway, all to say is, like, if you think about like this ratio of financial assets to real assets, I think NVIDIA has screwed up the math to these historical models. If you strip out NVIDIA, I think the world looks pretty normal. These ratios look normal, and yeah, fine. Maybe we have a classic summer correction, but it'd be an ordinary summer.
Yeah, well, I appreciate you pointing that out. It's one of those things. They both about the same average annual volatility at the moment, but for last year, it's and both about the same. And I do point, like, I just like pointing that out to crypto people, how insignificant Bitcoin is compared to things like NVIDIA. And then there's that example, if you're a money manager, a traditional money manager, and the end of the year and then the next year comes and you lose a little money in NVIDIA, no big deal. It's an equity and it was doing great and it was what you're supposed to be long. If you lose money in Bitcoin, good luck with that one.
Yeah, look, right. I mean, NVIDIA has the FOMO now, right? Bitcoin had the FOMO in Q1. And look, these are momentum assets. They run on attention. It's like if they have attention, they run. And so when NVIDIA loses attention, then that helps Bitcoin. So we'll see.
I want to ask you about that. That's what I'm worried about is that's what crypto people tell me. And I'm like, show me the beef. Anytime I can see if NVIDIA goes down, we know if the broad stock market goes down, S&P 500 beta, I want to show signs of the weakness in broad beta and divergent strength when that happens. I.e., good example. We had the last 5% correction we had in the stock market. What was that, April, May or so? Bitcoin dropped. S&P 500, Bitcoin dropped 20%. In 2022, S&P 500 dropped 25%, Bitcoin dropped 80%. Yes, you're always going to find the little nuances, but I mean the big moves. When you have a normal backup, a standard, when we get the standard 10% correction in equities, if Bitcoin doesn't drop its volatility weighted basis, which is 30 to 40%, that would be wonderful. But people tell me that's going to happen. I'm like, show me the beef. I haven't seen any signs of it yet.
I'll say, like, the downside volatility for Bitcoin relative to other cycles is pretty muted. I mean, we've had some pretty significant drawdowns during bull markets in the past, and we're not seeing that so much. I'm similar with NVIDIA, by the way, and they both have relative strength. Like, people are buying dips. I do see that as a bullish block, by the way. But the other part is, here we have a Fed. You raised a great point how Fed is like in this checkmate position. The Fed is going to cut rates in Q4. Inflation.
I'll ask you a question about that. We've been hearing that the Fed fund futures started pricing, the forward futures started pricing for 100 basis points of cuts in Q1 2023, and the Fed hiked 100 basis points. So it's just one of the things, that lessons from Benjamin Disraeli, when you generally anticipate something that doesn't occur. But what you said was what people are stating as fact. It's like, okay, what's going to be their trigger to cut rates?
Fair enough. Like I was definitely in the higher for longer camp that there's no Fed pivot, and in early or late December, people thought that pivot. This is nonsense. I think there's a difference now. First off, the Fed has guided markets. I think they're actually in the box. I think they're. It's more than that though. Like I think they can point to metrics that can justify a rate cut. But they've said, look, we expect to have rate cuts later this year. Their next move, if they make a move, is a downward move. And I guess the cacophony of noise around this is significant. So, I do believe they'll cut. But the funny thing is, like to your point, stock markets are at all-time highs, right? So if you cut rates now, we don't have a credit implosion like we had in 2007. We don't have a tech implosion either. We have global central banks cutting rates ahead of the Fed. Uranium's
up.
up.
The problem with their currencies.
Right. So I think Q4 is bullish. August, September, harder to say. I agree. There's just some funny things going on in certain pockets of the markets here and there, right? So you got to be, you don't want to chase the thing that went up last week. I would say it's probably the simplest way to put it.
Yeah. So you made some very profound statements. It's human nature to look at the last problem solved for the last crisis and dilemma and look forward. So you're right. I mean, credit is great. It's fine. We don't have the internet bubble. We have something similar and something else called AI, which I remember hearing first in undergrad in 1985. But now it's making a big difference. Can't deny that. But there's always been a reason for equities to get too expensive and too cheap. And that's why I just like to go back to the history. And you have to say there's certain times where I don't want to revert back too much, but that's why I want to rope in Bitcoin is, to me, the history of the way we're going to write this history. I hope I get old enough to tell the story and write the textbooks and tell the history of this period. And this is the way I perceive it. Bitcoin was born in 2009 of the great financial crisis, and the biggest money, interest rates going to zero was the alternative, right? And it was the best performing asset in history, and depends on which ones in the macro big sense. And it proliferated, but that world is different and changed now. And everybody tells me, yes, we're going to just pump more money in the system. Everybody's anticipating we're going to have lower rates. They're telling me this, and I hear that from everybody. I hear it from copper miners. I hear it from home builders. I hear it from, and it's like when everybody says the same thing.
Yeah, that's a great point.
And assets are priced for it. That thank you very much. And I just look at a typical hedge fund guy says, well, find option positions to play for that not working out as everybody anticipates.
Well, I fully agree with that. When everyone's talking about the same idea and it's fully priced, it's time to get on the other side of the boat. Some of this might just be tactical timing. And look, sometimes the consensus is right. And look, indices in general go up over time. That's consensus, and it's right. It's a question of
by design.
Right. But that's partially by design too. Their market cap weighting towards the best performers. So, here we have Dr. Copper, right? They call it Dr. Copper. It's like a leading indicator. Copper drives housing, big part of the economy, drives a lot of sectors of the economy. What are your thoughts on copper? Obviously, we had quite a sharp rally here, significantly overextended. By the way, to your point, I remember about a month ago, I think that was this flag here. I was listening to Bloomberg actually, and everyone was talking about copper, how there's a shortage and too much demand for copper, not enough. And then of course, like the next day on the week, it just kind of tanked lower here. So what's your take on copper and where it goes from here?
It's going down. I think it's going to follow interest rates lower, Chinese economy lower. First, let's start with the good macro big picture of copper. Copper made another new high. And it made a new high in 2022 upon the Russians' invasion of Ukraine, and crude oil didn't. There's the bend. Copper should continue to outperform some of the other more elastic commodities. The problem with copper is that high we just had was in the back of really significant speculative futures, just running it up, and they had a good reason. I mean, had a bit of a supply issue in Panama. We always have supply issues. They work themselves out. They have mines issues that work themselves out. But the number one place you have to look is for copper. Number one, first is start China bond yields, 2.23%. That's where copper might be going in terms of $1 per pound price. It's not profound. Copper is becoming a devil's metal like silver. It goes down because it went up, and then vice versa. And so another way to look at copper is overlay it with the U.S. 10-year notes since like I think it was like 2006. It's basically the same copper down per pound price as the U.S. 10-year note yield. And I fully expect at some point that's going to drop down to 3. I see that for copper. The key thing is what pushed it up, Ram, is still there. Managed money net positions futures that drive that market. I mean, the leveraged hedge funds that I used to work at and trade in myself and cover, pushed it up, and they're still way overweight long for copper to go higher. Same thing in natural gas. Managed money net positions got the highest, the most extended. This is versus open interest since 2020, since right before Russia invaded Ukraine. So that's another problem to push it lower. And so these things have been great for me to watch these lately because I used to trade them off them a lot. And it's just an indication that the commodity market that moved in the big broad basis up to that peak in 2022 and plunged all the way down to last year's low is now becoming a market of commodities. And copper is the number one, like the Dr. Copper. If you want someone to blame, I think fully expect it to go lower. So on the year, copper, U.S. copper is up about 16%. S&P 500 is up about 16%. So you can see the risks right there. Just a normal back and fill in S&P 500. Copper will be one of the first ones to go down. And if it doesn't, there's your good sign of divergent strength. I think hedge funds will jump on and say thank you. And so to me, copper is becoming a devil's metal and gets people bullish. When you see it on the tape making new highs, hedge funds come out and sell it, and they know it. And if you see it making, dropping down to couple year lows, come and buy it.
When you say devil's metal, what do you mean by that? So it's the behavior.
That's the nickname for silver. Yeah, the nickname for silver. And see, I see you still have some hair left. I don't. I've tried to trade silver, and it's like every single. It's just one of those things when you think it's going to go down, and you get bearish, and you put on a short position, bam, it goes up. And the same thing when it goes. It's just the devil's metal. Silver is the key thing about to tilt over a little bit is gold has been demonetizing silver for 100 years, certainly the last 20 years. There's a little bit of that happening with Bitcoin demonetizing gold, but now we're tilting back towards a period where gold's going to win. But the nickname for silver is the devil's metal, and that's why I'm pointing out that copper is becoming like that. The key thing that's happening that's changed is silver is much more of an industrial metal now, and there's only really one precious metal that's really money, and that's gold. But copper does have a very good negative correlation to the dollar, almost as much as the dollar.
Let's come back to Bitcoin. Let's come back to Bitcoin and gold in a second. One thing I want to point out briefly here is, so when the Fed met on May 5th and May 6th, their FOMC, they came out with their summary of economic projections. They said, hey, we think inflation is going to remain elevated. We think the economy is going to look all right in the back half of the year, growth. And, oh, by the way, we expect in our dot plot that we're going to cut. So that's this green bar here. And what I contend is that gave commodities a sugar rush, including copper, and now we're working that off. That's what we've experienced in the last, in the aftermath of copper. So, we'll see. It's going to take some time, but it is interesting. You remember like the cocoa craze as well. Any thoughts on cocoa and the fact that all these commodities were ramping at around the same time? Right? You had
cocoa, coffee. Yeah, where are they grown? Kind of not too far from the equator on the planet. You just look at the planet. And so they're definitely climate change related commodities. But the lesson with cocoa is I have a colleague who does writes on it, and I just do the technical analysis. It gave us one of those most classic technical signals ever. It was nice to be on top of it. I don't trade, but that's probably why I was right. If I was trading it and I put on a long position, I would have been stopped out. It's just the way it works as an ex-trader. But it had a good breakout. A lot of it's all climate related, but the lessons on when markets break out that parabolic, certainly commodities that will have an enduring period of low prices. The last time cocoa did this, I think it was in 1977. The peak was around 5,000, then it dropped to 900, and it took 40 years to get back to that level. So it's just a matter of time. It's just always the way it works. Don't underestimate the power of price to bring on supply and or alternatives and crush demand. Coffee lately is pumping up a little bit. We just going to put out a report on Monday pointing out managed money net positions in coffee are about the highest in 10 years. So specs are on it. Hedge funds are long it. And yeah, there's fundamental reasons for it. Some crop issues and stuff in Guyana, and mostly like the equator belt. But it'll go back down. It's just the way commodities work, and that's one thing. They're not like stocks. They go up because they go up. Commodities go down because they went up.
Right. I mean, I'm definitely more bullish on commodities. When they look, first of all, they're all correlated, and of course linked to the dollar. But you've got the support from the 200-day here, and again, you had that pump from the FOMC where they also announced they're tapering QE, and you had the sugar rush, and then like the hangover, and now markets are trying to find their footing. So it might take some time to stabilize, but that support is coming to bear. It might take 1 or 2 months, but it seems interesting. How about now on gold and Bitcoin? Do you think that Bitcoin can exceed gold in terms of market value?
Eventually, but it's going to be longer, and I have to get through one bridge at a time. The first way I like to describe it, and people have heard me say this for at least 5 years, in a world of rapidly advancing technology and going digital, not holding gold if you're gold, and not holding some Bitcoin if you're a gold investor is probably taking too much inordinate risk. So I still stick with that in the big picture, but in the macro, I love this Bitcoin to gold ratio. I've been watching it for 10 years. And it's showing divergent weakness. Right now, it's 26 ounces of gold per Bitcoin. The peak was about 37 in 2021, and we had a lower high this year. And everybody says, "Oh, that doesn't matter." It's showing divergent weakness. So the gold Bitcoin ratio is one of the key things I like to watch is signs of everything's going up. And right now, it's showing to me it's going to potentially break down below 25 and maybe even get to 20. I'd love to see it sustain above 30, but right now, there's good reason for it to continue lower. Let's put it this way. I believe with Saif and Dean Amos' book, The Bitcoin Standard. I mean, I read it when it first came out or listened to it. And I know Saif Dean, I've met him, that at some point central banks will be potentially buying Bitcoin. But right now, they're buying gold at, according to the World Gold Council, a colossal pace. Just to put the facts in order. Central banks since 2022, since about the end, have bought about 50 million ounces of gold. ETFs and managed money net positions in terms of futures are a little bit long right now. They're extended long, but they're only bought 1 million ounces over that period. And ETFs there's been liquidation selling of about 13 million ounces. At some point, you see what's happening. We have a Cold War that's heating up. The unlimited friendship between President Xi and President Putin, to me, changed all the landscape for gold. It's just gold you have to have some of it, and central banks are doing it. We know the main buyers are China. So I think gold, as matter time gets to $3,000 an ounce, I think it's put in pretty good bottom around 2,200. Just you got to have some nuances in between there. It's the fact that at some point we've had almost actually unprecedented outflows in gold ETFs. They've only been around for 20 years. At the same time, the price is going up. So I think at some point, those gold ETF outflows are going to switch to inflows. And there's one key fact that'll stop it, is that you need the investors to kind of give up a little bit in the U.S. stock market, just for a little bit. So I'll end with this. The key fact I've been saying is if you're any type of Western, certainly U.S. wealthiest country in the world investor, why would you buy gold with the S&P 500 on a tear and T-bills at 5%? At some point, we're going to little reversion in that, and I think gold will take off.
Fascinating. Terrific. Mike, how can people stay in touch and follow you and learn more?
Well, first of all, by watching this video. So I'll make sure I link it over. It's great to have you on. I appreciate meeting you in person. I'm looking forward to the next time. I'm on the Bloomberg terminal first, on X, Mike McGlone, at Mike McGlone 11, and on LinkedIn, Senior Commodity Strategist. And if people want, you reach out to me and get me their email. I'm happy to put them on my distribution list.
Thank you, Mike. It's a great Twitter follow, so please do follow Mike. Thank you, Mike. Until next time.
Thank you, Ram. I really appreciated the discourse, and I learned a lot. So I really appreciate you having me on. I'm looking forward to next time.
That's what we try to do. It's always about learning and being humble and trying to test your own ideas and find the other side and look around a corner. Try to find the bear before the bear finds you, right?
There you go. There you go.
All right. Thank you so much, Mike.
Cool.
You
Cheers.
Have a happy 4th.
You too.
Hey, Mike, before you log off,